everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to be talking about one of the more popular underlyings that you'll see here on is SPX. So if you're brand new to trading SPX or you're just learning about SPX, there are some things that are important to keep in mind. It's not like a normal equity where all the standard rules apply. And in fact, there's a lot of different things and a lot of non-standard things that apply to SPX. So let's get right into it and we'll discuss some of these things. So the first thing to understand with SPX is that there is a settlement date. So unlike regular equity expirations where all of them will have the last trading day as Friday, so on Friday's close at 3 p.m., that's it, that's the last time to trade it. There's actually a difference between what expiration we're looking at with SPX. So it's got a non-standard expiration, and so what's really important to keep in mind with that is that when we're looking at SPX expirations, if we're looking at a weekly expiration with SPX, it's going to be PM settled. So all these expirations are going to be on Friday, but determining whether it's PM or AM settled is going to determine the last day to trade it. So if we're looking at a weekly expiration, it's going to be PM settled. And this is going to be much like a normal equity, so something like Apple or Google. Those are going to have these PM settled expirations. So the last day to trade this would be on Friday. However, if we're looking at the regular expiration for the month for SPX, so which is usually the third Friday of each month, that would be the normal expiration. When we're looking at that one, it is actually an AM settled expiration. So what that means is the last day to trade it is actually Thursday at the close. So that's super important to remember, especially if you have positions in SPX. The last day to trade it, if you're dealing with the regular or third Friday of each month expiration, last day to trade it is Thursday. However, if you're looking at a weekly, the last day to trade that would be Friday. So let's dig into that a little bit deeper on the next slide here. So when we're looking at the regular expiration, or the third week of each month in the last Friday there, we're going to be looking at SET. So basically, the settlement price is based on the set price. And what's important to note is that the set price is based on the pricing of the opening print of all the S&P 500 components Friday morning. So as you can see here, we've got a ton of different contributions to the S&P 500, and the set price is based on the opening print of all of those S&P components Friday morning. So just thinking about that, we can kind of come to the conclusion that the previous day's close, or Thursday, is going to be very different than the Friday print of all these components in the S&P 500 come Friday morning. And that is the case. So when we're looking at set and the difference between the set price and the closing price of SPX on the previous day, which is Thursday, there's usually a pretty big difference. Sometimes it's pretty aligned, but there can be a massive difference, and that's really important to note. So let's go along to the next slide here, and we'll talk a little bit further about this. So why does this all matter? So when we're talking about the set price, the SPX closing price on Thursday is not going to be the P&L for your normal expiration. So when we're dealing, again, with that normal monthly expiration in SPX, whatever the closing price was on Thursday is not normally going to be the set price the next day. It could be, but it's normally not. And one thing to keep in mind is that the set price can be drastically different. So we actually did a research study on this, and we found that over the past few years, the largest differential was 19.5 points. And since we're dealing with SPX, which is $100 intervals, so 1 point is $100, that's $1,950 difference. So if I'm dealing with naked options in SPX or even defined risk, one thing that can happen is it can flip our position P&L on its head. So let's say I've got a winner. Let's say I sold a put in SPX, and let's say it expired, or I thought it expired out of the money on Thursday. But I didn't know that it actually expires and the P&L difference is based on the set price Friday morning. So let's say I sold a 2,000 put in SPX and the closing price was 2,005 on Thursday. However, when I went to go look at the set price the next morning, let's say there was a 15-point difference to the downside. So let's say SET was actually 1990. That would turn my winning trade into a $1,000 loser, less the credit I received from originally selling that put in SPX. So this is super important to note. And on the other side, if we're looking at losing positions, maybe they can turn into winners. So one thing to keep in mind is, let's say I've got a losing spread. So let's say I sold a put spread or credit spread and it's completely in the money. Again, when I'm selling a spread, I want it to expire out of the money. That's where it's going to give me that positive P&L. But if it's totally in the money, since my risk is defined, maybe I would consider letting it run through to see what the set price is, since I know that the set price is really what's going to determine my P&L. So it's super important to keep this in mind, and one thing we can do to avoid this is just keep in mind what expiration we're dealing with, and if we're not comfortable holding the position to see what the set price is, and there's really no way to know what that set price will be, it's really important to consider closing the position before letting that set price come into play. So if I'm dealing in the regular expiration and I know that it's going to expire, or the last day to trade it is Thursday, and on Friday morning the set price is going to determine my P&L, maybe I'll close it just before the close on Thursday as opposed to letting it roll through on Friday. So a lot of information here, but we can roll it all together with some takeaways on the next slide here. So, number one, SPX is a cash settled index that replicates the S&P 500 movement. So I keep referring back to the set price. Some people might be saying, well, doesn't this just turn into stock? Well, no, it does not. Since it's a cash settled index, we are dealing with a settlement price, and that settlement price is what determines the P&L of the position. So there's no actual SPX components where we can actually buy the stock or sell the stock. There is no stock in play at all. So it's very similar to something like the VIX, which would settle to VRO. So it's very similar. And one thing to keep in mind with SPX is that it's traded in 5-cent increments. So we get a ton of inquiries on the support line about SPX, and when you're looking at placing an order or routing an order, adjusting an order, if it's not in a 5-cent increment, it's going to decline the order and send it right back to you. So whenever you're trading SPX, make sure that it's in a 5-cent increment to make sure that the order will actually go through. Secondly, SPX weekly expirations are having a Friday trading close. So when we're looking at the weekly expirations, we can act as if this is a normal position like an Apple or Google, as we stated before, where the last day to trade it would be Friday, and after the close, that's when it would be determined based on the P&L. Again, the set price would not come into play here. It's going to be coming in off of the closing price of SPX that day. So weeklies will pretty much act like a normal expiration would. However, the SPX regular expiration is going to settle to that set price. So the last day to trade it is in fact going to be Thursday before the close. And lastly, set can be drastically different than SPX closing print. And this is really important. I can't stress this enough. This has happened to me before because I didn't even know that this existed. I was trading SPX. So this is a huge eye-opener and definitely something to be aware of, regardless of whether we're trading defined risk or undefined risk. This can either hurt us or help us depending on what's going on. So if we're looking to avoid that set price and that set determination of the P&L, maybe we'd consider closing the trade prior to that. So hopefully this has shed some light on SPX for you. My name is Mike. If you've got any questions or feedback at all, shoot me an email at support@dough.com or support.com, or you can shoot me a tweet at DoughTraderMike. We'll be back again at the same time tomorrow, so have a good night. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.